Namaste and welcome to course number 4, that is FNO Foundations. I am your financial guide from Fintamin. Features and options are the most powerful and most dangerous instruments in the Indian stock market. India's NSE is the world's number one derivatives exchange by contract volume. Every day, retail traders enter this market, and per SEBI's own research, 89% of them lose money. Not because FNO is impossible to understand, but because they start trading without understanding the basics. This course changes that. In 12 modules, I will give you a complete foundational understanding of how derivatives work. From contract specifications and margin requirements to option Greeks, multi-leg strategies, and a complete FNO trading plan. By the end of this course, you will understand FNO better than 95% of people currently trading it. One most important note before we begin is this course is for education only. It is not trading advice. Please consult a SEBI registered investment advisor before placing your first FNO trade. Here is your roadmap. Module 1 introduces derivatives, what they are and why they exist. Module 2 covers the FNO ecosystem, lots, margins, expiries, calendars, etc. Module 3 is futures contracts, pricing, basics, MTM settlement, rollover. Module 4 introduces options, call, put, strike price, option chain, etc. Module 5 decodes option premium, intrinsic value, time value, implied volatility. Module 6 covers the Greeks, delta, gamma, theta, vega, etc. Module 7 and 8 covers option buying and selling strategies. Module 9 introduces multi-leg strategies, spreads, straddles, iron condor, etc. Module 10 focuses on index options, Nifty and Bank Nifty specifically. Module 11 is risk management in FNO, the most critical module, and Module 12 puts it all together into a complete FNO trading plan. Let us begin. Module number 1 is what are derivatives? Before you can understand FNO, you need to understand what a derivative actually is and why it was invented. This foundation changes everything. What is a derivative? A derivative is a financial contract whose value is derived from an underlying asset, a stock, index, commodity, currency, or interest rate. The derivative itself is not the asset. It is a contract about the asset. Let me give you a relatable example from everyday Indian life. You want to book a flat in Pune for 80 lakh rupees. The builder asks for 5 lakh as token money today, with the actual sale happening in 18 months. That token money agreement is essentially a derivative, a contract whose value depends on the future price of the flat. If flat price rise, your agreement becomes more valuable. If they fall, you might walk away and lose the 5 lakh. Financial derivatives work exactly the same way. 4 types: futures, agreement to buy or sell at a predetermined price on a future date. Second is options, the right, not the obligation to buy or sell. Third is forwards, like futures but traded privately, not on an exchange. And fourth is swaps, exchange of cash flows used by institutions. In India's retail market, you will primarily use futures and options on stocks and indices. This is our focus in this course. Why do derivatives exist? Derivatives were not invented for speculation. They were invented to solve a genuine economic problem, that is, risk transfer. There are three legitimate uses. First is hedging, reducing risks on an existing position. For example, you own Reliance shares worth 10 lakh rupees and are worried about a correction. You buy Reliance put options as insurance. If Reliance falls, your put gains offset the loss in your shares. This is exactly how large equity investors protect their portfolios. Second is speculation, profiting from price movement using leverage. You believe Nifty will rise 200 points. You buy Nifty call options with 50,000 rupees of margin to control a position worth 16 lakh rupees. Leverage amplifies both gains and losses. Third is arbitrage, exploiting price differences between markets. If a stock trades at 500 in the cash market and 502 in futures, buy spot and sell futures. Pocket 2 rupees risk-free. This is now done entirely by algorithm trading systems in microseconds. The SEBI study showed that 89% of individual FNO traders lose money. The primary reasons: speculation without a plan, excessive leverage, and no stop losses. This course is your antidote to all the three. FNO market in India. Let me share some numbers that will give you a sense of the scale of India's FNO market and why understanding it matters. India's NSE is the world's #1 derivatives exchange by contract volume. Daily FNO turnover exceeds 400 lakh crore rupees in notional terms. Over 90% of this volume is in weekly Nifty and Bank Nifty options, specifically the weekly expiry contracts. More than 1 crore unique traders are active monthly in NSEs and FNO segment. And the stat that should make every FNO trader pause. SEBI's 2023 study found that 89% of individual FNO traders made a net loss over 3 years. The average loss per trader was 1.1 lakh rupees per year. These numbers are not meant to discourage you. They are meant to motivate you to be in the 11% who succeed. By learning, by planning, and by never trading without a systematic framework. Equity versus index FNO. Two main categories of FNO in India. Equity FNO is on individual stocks. TCS, Reliance, HDFC Bank. Index FNO is on indices. Nifty 50, Bank Nifty, or Fin Nifty. Key differences: equity FNO can result in physical delivery of shares on expiry. This has caught many traders by surprise. Index FNO is always cash settled, much simpler. Equity FNO has monthly expiry only. Index FNO has weekly expiry, like every Thursday for Nifty, every Wednesday for Bank Nifty. My recommendation for beginners is start exclusively with index options. Better liquidity, cash settlement eliminates delivery risk, tighter bid-ask spreads, and the instruments are thoroughly covered in research. Nifty and Bank Nifty first. Equity FNO only after 1 year of index experience. Now let us understand the infrastructure of the FNO market in module number 2, that is the FNO ecosystem. Lot sizes, margin requirements, expiry calendars, and the key terms you must know before placing your first FNO trade. This is your vocabulary lesson. Key terms you must know. 6 terms. Memorize them before proceeding. Underlying asset, the actual stock or index that the derivative is based on, like Nifty 50, Reliance, and HDFC Bank. Lot size, the minimum quantity you must trade. You cannot buy half a lot. Nifty lot is 75 units. Bank Nifty lot is 30 units. Fin Nifty lot is 65 units. These change periodically. Always verify on NSE before trading. Expiry date. The last trading day for a contract. After expiry, the contract ceases to exist. For weekly Nifty options, every Thursday. For Bank Nifty, every Wednesday. For monthly futures, last Thursday of the month. Strike price. The pre-agreed price is an option contract. ATM at the money is close to current market price. ITM in the money has real value. OTM out of the money needs price to move to have value. We cover this in detail in module 4. Premium. The price of an options contract. The buyer pays premium. The seller receives premium. It changes every second based on market movement, time, and volatility. Margin. The security deposit required to take an FNO position. Futures and option selling require margin. Option buying only requires the premium payment, no additional margin. Let me give you the exact specification of India's two most traded contracts. Nifty 50, lot size 75 units. One lot controls approximately 16 to 18 lakh rupees of index value. Weekly expiry every Thursday. Monthly expiry is on the last Thursday. Always cash settled. Margin for futures approximately 1.3 to 1.5 lakh per lot. Bank Nifty. Lot size 30 units. One lot controls approximately 14 to 16 lakh rupees. Weekly expiry every Wednesday, not Thursday. An important difference. Monthly expiry on last Wednesday, cash settled. Critically important. Bank Nifty expires on Wednesday. Nifty on Thursday. Fin Nifty on Tuesday. If you confuse these expiry dates, especially near expiry, you could hold options that expire worthless without realizing it. Know your expiry days. Set calendar reminders. To take any FNO position, whether futures or option selling, you need margin in your account. NEC uses a system called SPAN, Standard Portfolio Analysis of Risk. To calculate this, SPAN margin is the initial margin calculated by the exchange based on worst case risk scenarios. For Nifty futures, this is typically 80,000 to 1 lakh rupees per lot depending on volatility. Exposure margin is an additional buffer your broker requires, typically 3 to 5% above span. Total margin for one Nifty lot is generally 1.2 to 1.5 lakh rupees in 2026 market conditions. The most important rule about margin: if your account balance falls below the required margin level, your broker will automatically close your position, even at loss, without asking you. This is called a margin call. Maintain at least 120% of required margin at all times. Never run your account at the margin limit. Margin call is one of the most painful experiences in FNO trading. It typically happens at the worst possible movement, during high volatility when you most need the position. Always maintain a buffer. The expiry calendar. Understanding the expiry calendar is critical for FNO traders. Time decay, which we call theta, accelerates dramatically in the final 3 days before expiry. Options that seemed safe suddenly lose 40 to 60% of their remaining value in the last 2 days. Monday, new weekly cycle begins. Option sellers initiate positions, collecting maximum time value. A good time for sellers to enter new trades. Tuesday, FinNifty weekly expires. If you hold FinNifty options, square off by 3 p.m. Wednesday, Bank Nifty weekly expires. Gamma risk is extreme. Even a 0.5% move can change option values by 200 to 300%. Experienced intraday traders only. Thursday, Nifty weekly expiry. Highest volume day of the week. New monthly contracts begin. Always square off Nifty options by 3 p.m. Never hold to the final 30 minutes. Friday, post expiry, new week setup, research and planning. No overnight FNO positions on Friday evenings unless you specifically understand the weekend risk. The infrastructure is clear. Now let's understand the futures contracts in depth. Module number 3 is futures contracts. Futures are the simplest derivative instrument, but they have unique features. Daily MTM settlement, rollover, basis that make them very different from buying a stock. Let me explain every one. How futures work. A futures contract is an agreement to buy or sell an asset at a predetermined price on a specific future date. Both buyer and seller are obligated to fulfill the contract. Example, Nifty spot is at 22,500. You are bullish. You believe Nifty will rise. You buy one Nifty futures lot at 22,520. The current futures price. Lot size 75. Total contract value equals 22,520 multiplied by 75 equals 16.89 lakh rupees. But do not pay this amount. You only pay margin approximately 1.3 lakh rupees. This is your leverage. 1.3 lakh controls 16.89 lakh of exposure, approximately 13 times leverage. If Nifty rises to 22,700, your profit equals 22,700 minus 22,520 multiplied by 75 equals 180 multiplied by 75 equals 13,500 rupees profit. 1 Nifty point equals 75 rupees per lot. If Nifty falls to 22,300, your loss equals 22,520 minus 22,300 multiplied by 75 equals 220 multiplied by 75 equals 16,500 rupees loss. The loss is deducted from your account the same evening. Emphasis: the every Nifty point equals 75 formula. Futures price is almost always different from spot price. The difference is called the basis. Understanding this explains why you sometimes see Nifty futures at 22,550 when Nifty spot is at 22,500. Fair value formula. Futures equals spot multiplied by 1 plus risk-free rate multiplied by days to expiry divided by 365 minus dividends expected before expiry. With risk-free rate around 7% and 30 days to expiry, futures should trade approximately 80 to 100 points above spot. This is the cost of the carry, the interest foregone by using capital to buy futures instead of treasury bills. Contango is when futures are above spot, the normal condition. Backwardation is when futures are below spot. Unusual signals bearish sentiments or large expected dividends. Most importantly, on the expiry date, futures price must converge to spot price. The exchange settles all futures at the final spot price. This convergence creates opportunities and risks for traders holding futures through expiry. This is where futures are fundamentally different from stocks and from options. MTM means mark to market. Every single rollover extending your position. Rollover means closing your expiring contract and simultaneously opening the same position in the next month's contract. This is how traders who want to hold position beyond expiry extend their futures trade. The process: around the 25th of each month, track the rollover percentage on NSE. How much of the total open interest has already over to next month? High rollover above 75% means traders are bullish enough to carry positions forward. Low rollover means uncertainty. The cost of rollover is the difference between the next month's futures price and the current month, typically 50 to 80 Nifty points due to cost of carry. This is your cost extending the position. Market signal. High rollover percentage with positive basis means institutional consensus is bullish. Watch this data every month. It is one of the cleanest institutional sentiment indicators available. To buy futures are fundamentally different from stocks and from options. MTM means mark to market. Every single evening, NSE calculates your futures gain or loss and credits or debits your account. It does not wait until you close the trade. Example, day 1, you buy Nifty futures at 22,500. Day 1 closes at 22,380. Loss of 120 points multiplied by 75 equals 9,000 rupees debited from your account this evening. Day 2, your new reference price is 22,380. Day 2 closes at 22,600. Profit of 220 points multiplied by 75 equals 16,500 rupees credited to your account. Why does this matter? Because if your account balance falls below the margin requirement due to MTM losses, your broker will call you for a top-up by 11 a.m. in the morning. If you cannot top up, they will square off your position automatically. You lose the right to decide your own exit. Rule: always keep enough cash buffer in your trading account to absorb at least 5 to 7 days of adverse MTM before being forced to exit. Never run your futures account at the margin limit. Futures are straightforward obligation to buy or sell. Options gives you the right, not the obligation. That distinction changes everything. Let us move forward to module number 4, that is options. This is where it gets truly interesting. Options give you something futures do not: defined risk. Your maximum loss is always known before you enter the trade. Let me show you how. An option gives the buyer the right, not the obligation, to buy or sell an asset at a pre-agreed price before or on the expiry date. The seller has the obligation if the buyer exercises that right. Call op call option. खरीदने का हक. The right to buy at the strike price. Buy a call when you are bullish. For example, Nifty is at 22,500. You buy the 22,500 CE call option at a premium of 150 rupees. Lot size 75. Total cost equals 150 multiplied by 75 equals 11,250 rupees. This 11,250 rupees is your maximum loss, no matter what happens to Nifty. No matter what happens to Nifty. If Nifty rises to 22,800, your call is now worth approximately 300 rupees or more. Profit equals 150 rupees per unit times 75 equals 11,250 rupees profit. Put option. बेचने का हक. The right to sell at the strike price. Buy a put when you are bearish or want to hedge. For example, Nifty at 22,500. Buy the 22,500 PE at premium 130. Total cost equals 130 times 75 equals 9,750 rupees. This is your maximum loss. If Nifty falls to 22,200, your put gains significantly. The most important feature of buying options: your maximum loss is always limited to the premium paid. You can never lose more than what you paid. This is what makes option buying safer than futures for beginners. Strike price and moneyness. With Nifty at 22,500, let me explain ATM, ITM, and OTM using real numbers. ATM price. ATM at the money. Strike closest to current price. The 22,500 call and 22,500 put at ATM. Highest time value. Most sensitive to small price moves. Most liquid. OTM. Out of money. For calls, strike above current price. The 23,000 call is OTM. Nifty would need to rise 500 points before it has intrinsic value. For puts, strike below current price. The 22,000 put is OTM. OTM options are cheap, 50 to 100 rupees, but 90% of them expire worthless. They are lotteries. Avoid deep OTM buying. ITM in the money. For calls, strike below current price. The 22,000 call is ITM. It already has 500 points of intrinsic value. More expensive, 600 to 700 rupees, but behaves almost like futures. High delta, less time decay impact. My recommendation for option buyers is always buy ATM or at most one strike OTM. Deep OTM options sound attractive because they are cheap, but they expire worthless the last majority of the time. For sellers, sell OTM options to collect premium. The asymmetry between option buyer and seller is fundamental to understanding options. Let me lay it out clearly. Option buyer pays the premium. Maximum loss equals premium paid, limited and defined. Maximum gain is theoretically unlimited for calls. Very large for puts. Probability of profit is approximately 30 to 35%, lower than 50-50. But when you win, the gain can be 3 to 10 times the premium. Capital required, only the premium, no margin. Option seller receives the premium. Maximum gains equals premium received, limited. Maximum loss is theoretically unlimited for naked selling. Probability of profit is approximately 65 to 70% in your favor. But when you lose, losses can be 5 to 20 times the premium collected. Capital required is full margin, 10 to 15 times the premium. Neither role is inherently better. Option buyers make money on large directional moves. Option sellers make money on time passage and stable markets. Your choice depends on your market view, capital, and list. Your choice depends on market view, capital, and risk tolerance. The option chain is the most important table in all of option trading. Available free at optionchain.nseindia.com. You should check this every trading day before the market opens. 5 key columns to understand. Open interest. OI is the number of outstanding contracts at each strike. High OI is at strike means heavily institutional interest. The strike with highest call OI is typically the resistance level for that expiry. The strike with highest put OI is typically the support. Change in OI tells you whether positions are being added or closed. Rising OI with rising price equals long build-up. Institutions buying. Rising OI with falling price equals short build-up. Institutions selling. Failing Falling OI with rising price equals short covering. Bears exiting. Bears exiting. Volatility shows how expensive options are at each strike. Higher IV. Higher IV means options are expensive. If IV is at 52 weeks high, premiums are expensive. Better to sell options. If IV has 52 weeks low, premiums are cheap. Better to buy. PCR is put call ratio. Total put OI divided by total call OI. PCR above 1.2 means many put buyers. Contrarian bullish signal. PCR below 0.7 means too many call buyers. Contrarian bearish signal. Max pain, the strike where maximum option buyers will lose money at expiry. Markets tend to gravitate toward max pain in the final hours of expiry. Check this every Thursday morning for Nifty expiry. We shall continue the next part of this course, which is Option Premium Anatomy in module number 5 in the next video. I would request all the viewers to please subscribe to stay updated with latest educational videos and visit fintamin.in for more insightful knowledge on stock markets and financial planning. See you in the next video.